Hello, everybody. John the Economist here. And today's stream is going to be essentially dedicated to three topics. And we're going to kind of do it in a movement of three for that reason. The first one is going to discuss what I think is a very difficult to handle situation that the Federal Reserve is in. And I'll do some discussion on how monetary policy functions as a result. We have covered kind of topics similar to just the basic functions of monetary policy in the past, so I probably won't be going as in depth into the mechanics and just kind of discuss what the current situation the Fed is dealing with is. Second thing I'm going to talk about is Bitcoin's role as an inflation hedge. The main reason for that is because I see a lot of people saying that Bitcoin is a poor inflation hedge because it is going down during this high inflationary period. But I think I'm going to offer some context that might change people's opinions on that, even if it's slightly, or at least just add some context. And the third thing I want to talk about is just the odds and likelihood of a recession based off of several indicators and things like that. And also, as always, please make sure to leave a comment if you have any questions whatsoever. I will be reading them and I will be answering them as we go along here. Super excited for today's lesson. One thing I want to mention too before we dig in is last stream when I talked about a bear market, I do want to say I still hold by the stance that bear markets are opportunities, right? What aren't necessarily opportunities are recessions. They can be, but I'd say the reality of what a recession does to, a household, the economy obviously as a whole, opportunities that you have in the future as a result of living through a recession, especially somebody my age who's, just recently graduated college. Those realities are a little bit tougher, right? Bear markets, I'd say, the consequence of living through a bear market, right? I mean, your portfolio is supposed to be something that you hold on to long term. You plan on cashing out on your portfolio on a 12-month or 24-month time frame. That's totally on you, and you knew the risk associated with that. So that's why I pretty strictly feel bear markets are opportunities. But markets and the economy are different things, right? They follow each other, right? Like when the economy looks recessionary and things look rough, the markets will be bearish naturally, but the markets can also be bearish for other reasons. And the markets can also, I'd say, be falsely bullish, right? And I think that the recession that we lived through in 2020 was a great example of that, where the economy itself obviously wasn't doing great because we were living through a pandemic in which most of the economy was shut down, but the markets looked really bullish during that time. So while yes, there's confluence. If we're 100% going through a recession, it's very highly likely we're going through a bear market. But it doesn't necessarily mean that we're in a recession because we're in a bear market or vice versa, right? 2001 was another great example. The dot-com bubble crashed, and despite a very brief recession and after 9/11, the American economy was doing just fine, despite the fact that there was a very serious, severe bear market going on in the stocks. So that's worth noting. And I think the realities of recession are much harsher. They're much more serious. They're a lot tougher for the average person to deal with than a bear market. A bear market, just blind your eyes to the price of whatever you're investing in and just keep on investing in it, right? And as long as what you're investing in actually is a fundamentally strong asset, you're going to be in great shape in the future, right? That's why bear markets are opportunities. But recessions, they're great at filtering out some noise or some things that aren't creating value. And the people that survive recessions and, find ways to be entrepreneurial and innovative and such during a recession end up being great. But the recessions have clear winners and losers, and it sets the terms for who's suffering the consequences in the future, right? So that's why I just wanted to take a minute to disclaim that is this subject's a lot tougher and a lot more serious, I'd say, than a bear market, where last stream I was like, yeah, it's a bear market. Just call it what it is. Here's some strategies to deal with that bear market and enjoy the ride, right? Recession's not right. It's not the demeanor that I want to have during a recession. So I want to start this off with the Federal Reserve because I think that the Federal Reserve unfortunately made some very poor monetary policy choices over the past 2 years, and they are going to exacerbate the potential consequences of a recession. And even if they don't, they might exacerbate the fact that if we're not recessionary, we're sure as heck not going to be like a happy-go-lucky economy for the next 2 years. And there's a lot of reasons for that, but I just exclusively want to talk about the Federal Reserve's role with interest rates, right? So as we know, when the lockdowns occurred, the Federal Reserve decided to print a whole lot of money, and we've covered this a lot of times. You can see the clear change in trajectory of our money supply when this happened, and we had this honeymoon phase, I like to call it, where it did exactly what increases the monetary supply via low interest rates cause, which is economic stimulus, right? Which increases demand. It does not increase supply, and this is very important, right? So just generally speaking in the aggregate, right? Printing new money doesn't necessarily imply that just supply side economics are going to increase, right? What they do is get people spending more. It increases demand, right? It increases quantity. You're trying to get people spending to make the recession, better for them to handle. And this has been widely accepted as our standard monetary policy, referred to as modern monetary theory, since around the 1970s when we got off of the gold standard. Now, there's been several phases of this, and it's a little bit tougher to see just looking at the money supply in general. But if you look at the federal funds rate, which is the interest rate that the Federal Reserve charges to banks to borrow money, is that this has been in a steady downtrend, right? Which means that the money supply is becoming more and more and more liquid. And as you can see, we drop these interest rates during recessionary periods to try to stimulate demand, to get people spending, to kind of keep the economy humming when otherwise we'd be in a tough spot. And the common critique to this method is that in the long run, this has a lot of negative effects, right? And for the longest time, people have always said, well, where are the negative effects, right? Where is this inflation that you're so worried about? Is this really causing wealth inequality? Like, is this going to have a negative effect on stocks? And the answer to that particular question was really dubious for a while, because I'd say the level to which we practiced this monetary experiment wasn't as severe until recently, right? So you see, we abandoned the gold standard in 1971 to be exact. We had a peak out, from the 70s into the early 80s, because that was kind of a recession or pre-recessionary period. And then early 80s, we did actually have a recession, and this is where we kind of began dropping interest rates, putting more money into the market so that people get spending it. But you see that these interest rate drops and recoveries have gotten more and more severe with each recession, right? They're getting more and more crazy, and they're never getting to the previous highs. And I don't know if it's likely that we'll get to the previous highs of 2018. And we'll kind of explain why in a moment, right? So I think we're starting to see the reality of what the situation can cause when you print too much money and there isn't economic growth to meet it, right? And what that is generally is inflation. Now, this isn't the only thing contributing to inflation. There are several other things contributing to inflation: supply chain issues, macroeconomic uncertainty, major shifts in our economic structure with the job market, with the housing market, things like that. And then obviously the Russian-Ukrainian war that is going on. All of these things do contribute to inflation, but at the end of the day, inflation, to quote Milton Friedman, is always a monetary phenomenon, right? It's at the end of the day, if you're printing money, asset prices are going to inflate if you do it for too long of a period. That was Friedman's big critique. There are more modern economists that would suggest that it's a financial phenomenon or a there's our financial policy can also dictate inflation. Making poor financial decisions can cause inflation. But I like Milton Friedman's answer that it's a monetary phenomenon. So we had the honeymoon phase through 2020 where we printed a lot of money and it didn't matter. It did exactly what it expected. Demand increased, people were out spending and doing whatever with their money, with the stimulus, with the unemployment, etc. Then inflation started creeping up, right? So let me go to the CPI, right? Started creeping up like crazy. You can see just how serious this started to get. But keep in mind, like, this really didn't start to kick in like crazy. If I can find my inflation rate. Good job, John. I'm struggling to find my actual inflation rate one, but the CPI does a decent job of describing this. But this really didn't start to go parabolic until about midway through 2021 and didn't start becoming like crazily abnormal until probably closer to 6 to 8 months into 2021, right? It was like, oh, like 2 to 3% year over year inflation, which isn't unheard of. That happens. And you start getting a 5, 6, 7, 8% inflation. That's significantly more serious. But we didn't start creeping up to those levels until about a year after we began lowering the interest rates, printing a lot of money, right? So this is where I think the Fed's in trouble, is because they're finally starting to raise interest rates, and they're admittedly quite aggressive about how they plan on doing that. They're going to be doing two 50 basis point increases over the next 3 to 4 months is the guess, with additional 25 basis point increases. And by basis point, we just mean percent, essentially, right? So, theoretically, like, this should be up to like here by the end of the year, right? But the problem is that we are seeing recessionary pressures, and the stock market looks like garbage. People are afraid about the war. People are afraid about the supply chain issues, drought, energy crisis, right? There's a lot of different issues that are playing into this. And as the Federal Reserve sees that, right, their job is to maintain employment and keep the economy humming, but it's also to keep inflation at bay. And now they're going to be in a rock and a hard place between, we need to reel in inflation through increasing interest rates, but we also need to not force a recession to happen. Or we need to not make the recession worse because we are constraining the economic engine with our monetary policy decisions. This is called stagflation. When you get recession plus inflation, it's a knockout punch for an economy. It takes a very long time to recover from, generally. What's worse is that it's a long and painful time to recover from something like stagflation. But additionally, what can happen is the Federal Reserve might fail at either stopping the recession or reeling in inflation, or both. And when we see, I'm not suggesting this is for sure what's going to happen. In fact, I'd say that this is unlikely that it's going to happen. But when central banks in the past have been caught between this rock and a hard place, the monetary supply starts to whipsaw in a really concerning way. You can see it. Let me see, Weimar Republic inflation, or I'll even say monetary base. All right, we're going to do some Googling together. Hopefully that's okay with you guys. Nope, that's not what I'm looking for. This might be what I'm looking for. Yep, okay. So if you see here, you're getting a whipsaw pattern in the monetary base to start, right? And this is what scares me, is if we start seeing something like this whipsaw pattern of recession, right? Try to stop recession, try to stop inflation, try to stop recession, try to stop inflation. And as a result, you never actually stop both of them. You're just stuck between a rock and a hard place, right? So with this, right, let's say the recession gets too bad and the Federal Reserve kind of caves in and we start going down again, right? And then even though maybe let's say that, eases some short-term economic woes, what happens is the CPI, this consumer price index, which is an inflation indicator, starts continuing to go parabolic, right? And then, okay, well, we got to calm down this recession a little bit. So what if we, go back to this and, right, and we started doing this, and okay, now we need to make the interest rates higher again to try to combat this inflation that we just exacerbated. And this starts to go down, but then we get recessionary pressures again, right? And you see how this can again turn into just kind of like a whipsaw pattern with the monetary base trying to be in this rock and this hard place, this impossible situation between combating recession and inflation. And what happened in the past when the central banks finally got in a situation where they couldn't handle this is it started to whipsaw back and forth and then eventually went parabolic, right? So again, I'm not trying to say that this is for sure going to be what America's fate is doomed to. I think that's actually very unlikely. But I am saying that it's something I'm going to be looking out for in the future because I think it's a rather concerning situation that we found ourselves in, right? So that's kind of the rock and the hard place, but that the Federal Reserve is caught in, and why I think they're kind of in a very tough, dicey situation with that. Right, they're finally starting to roll back on their balance sheet. The monetary base finally doesn't have this crazy upward trajectory. It's actually starting to curl down a little bit. These are things that we needed to happen, and you'd hope to see that the CPI eventually starts to roll over as a result. But if it doesn't start rolling over as a result before we have to lower interest rates and start printing money again, that could be a massive problem. So just keep an eye out on it. The next thing I want to talk about is Bitcoin as an inflation hedge. Now, a lot of people are saying that Bitcoin has failed as an inflation hedge because we're in a time of high inflation and Bitcoin's price is not appreciating. And they're not wrong about that assessment. We are in a time of high inflation and Bitcoin's price is going down. So, wow, some crummy inflation hedge, we have here, right? This is not doing as advertised. However, and this is the important context, is what it means to hedge is to be anticipation of some other condition, right? To hedge against something, meaning to protect oneself from, to hedge against inflation by investing their money, looking for ways to hedge against risk failure. The idea is that the thing hasn't happened yet. At least that's my perspective on what it means to hedge. Because you're not hedging against anything if that thing's already here. You're just reacting to it, right? To hedge is to assume that in the future something's going to happen, right? That's why I'm hedging my bets for something, right? Like it's anticipating a future result. So what did I say with the inflation rate is that it really started to go like parabolic. We'll say I'd say February or March of 2021. So that's February or March of 2021. So then if we go back to Bitcoin's price, we're going to go to March of 2021. What was happening? Bitcoin was hitting its top. And then inflation started to kick in and Bitcoin struggled. Why did Bitcoin struggle? It's because what did Bitcoin do before the inflation started to kick in? That's the most important part. If you're measuring from when the Federal Reserve lowered interest rates, Bitcoin appreciated 11x. So let me repeat that again. Before the inflation kicked in, Bitcoin's price appreciated 11x. If you're hedging against inflation and you have an asset that appreciates 11x before the inflation kicks in, what are you going to do? You're going to take profit. And that's what most I shouldn't say most, there's a lot of people holding bags right now, and there's a lot of people that first got into the market in this upper area. But those people weren't hedging against inflation. The inflation hedge already worked, right? Those people are just buying into inflation as it's happening, hoping that this continues to be on the same trend, which it could have been. But here's the thing is if you hedged against inflation and you now have 11x more dollars than you did beforehand when inflation only increased by 10%, right? It's 1100% versus 10%. You're going to take profits. You successfully hedged inflation by a huge margin, right? And I know people that did this, and I'm not going to name names, but like there are people that I know that bought Bitcoin, through early 2020, and then during mostly actually this top, not so much this top, right? Because this top, they saw how bad the inflation pressures were getting. This top, they just thought, okay, it was a top, but the economy wasn't looking so crummy at that point. And they did it to buy a house, to buy a car, to, renovate their house, right? With money that they didn't have beforehand, going into tangible physical assets that they could resell later, maybe at a profit if it's a house or if it's a renovation to a house. So to me, right, Bitcoin's function as an inflation hedge more than served its purpose. And then human nature just started to take over once people are like, wow, inflation's really bad. The economy looks like garbage. Cash is probably king right now because the economy looks like garbage. Let me take my money out of this asset that has done really, really well for me and have given me a lot more money during this inflationary period so that I can handle this inflation better, right? To me, that's what, and people, might say, okay, well, if that's the case, it's correlating with tech stocks or equities really hard. Why wouldn't you just invest in equities? That's true. Bitcoin's gains have outpaced every equities during the same time period. Again, let's take the March 2020 capitulation up to just the first top. I'm not even going to take it to the second top, which hit a higher price. The first top, we'll say it's 1,500% increase, just to be fair to this. We'll round down. And then you look at, indexes like the Dow Jones, and you take its capitulation, wick, right? I mean, there you're in the same time period, right? You're up about 100%. And I'm sure you guys already know how this game is going to play out. Do it with the NASDAQ, it's 150%. If you do it with the S&P 500, it's about 125%. If you do it with Tesla, which is, bragged to be one of the best performing stocks of the decade, that about kept pace with Bitcoin. So Tesla kept pace with Bitcoin. Keep in mind, Tesla had Bitcoin on their balance sheet. Amazon, we're probably going to say kept pace with Bitcoin as well. Maybe not. Where's the capitulation wick right there? Not even close. Never mind. 128%. Google, 200%, right? And so on and so forth, right? Equities did not do as good of a job hedging against inflation as Bitcoin did, because in the same time period, they put in 100, 150, 200% gains, while Bitcoin put in a 1,500% gain. I think it's a fair argument. And again, I get that the people that, bought here rather than here don't think that's a super convincing argument, but like you didn't hedge against inflation. The inflation was here and you tried to start reacting to it at that point. But also I'd say if you remain consistent in this range, you'll eventually, break out and probably hedge against inflation just fine. But like the markets are bearish, everything looks bad, and Bitcoin is reliant on energy to function, which I wonder if my boss is watching this right now, but he's made a very profound point about if something relies on energy to function, and energy is just inherently more expensive right now due to the war and the supply chain issues and all of those things, then like it's going to be more expensive to mine and operate and own Bitcoin, which is probably going to have an effect on its price, right? So things worth keeping in mind. And then that leads me to my last point for this stream, which is we're going to take a look at some potential recession indicators, right? And, this might be like a recession that almost has to happen because of the everything bubble that was created by bad monetary, it might be mad monetary policy too, by bad monetary policy of the past couple of years. We had an everything bubble. Houses totally skyrocketed, right? I have people in my life that have been trying to get a house for 6 months, a year, and have struggled because the housing market is just going nuts, right? And additionally, the gas prices are super ridiculous. Things are insanely expensive, and it's not just from general inflation rates. It's exponentially more in certain markets, right? The CPI might only be up 8 or 10%. The housing market's up way more than that. Gas is up way more than that. Computer parts are up way more than that. Lumber's up way more than that. Wheat and like other food related commodities are up way more than that, which is not good, obviously. And all of those in traditional time periods, I'd say can indicate recession. Now, there are some pros and cons to this, right? I don't think we're going to get like a housing market crash like we've seen in the past. And, like a 2008 situation where a bunch of people are foreclosing and, getting evicted, and a bunch of different firms are going under as a result of that type of crash. And the reason why is because it's actually pretty tough to get into a house right now because of how high prices are. So a recession would actually cause the housing market to cool off in a healthy way, which I think is a good thing, right? Because people can't afford houses, and we want people to be able to afford houses. Your your demand for a place to live is essentially inelastic, right? Which what that means is usually your demand is what's referred to as diminishing marginal utility. The more quantity that you have of something, the less that you want, and the more that the slope is, the more elastic you are, right? To be entirely inelastic means that regardless, your demand curve is the same. Regardless of the price, you need the same quantity, right? So it looked like this, right? Whatever the supply is doing, you need a house. Doesn't matter if the price is there or the price is there, right? This axis is the price, this axis is the quantity. Doesn't matter where the price is at, you need a place to live. So the housing market rolling over and becoming more affordable isn't necessarily a bad thing. I'd say that's a good thing that's resulting in the Fed combating inflation and people being a little bit more risk off and careful with their money, right? What is bad is how expensive it is to exist in general right now, and how some of those things aren't going to be solved by the housing market rolling over. Commodities are insane right now. This is the commodity consumer price index. I mean, you can zoom out basically forever, and there hasn't really been a skyrocket in commodities the way that there's been right now. That's scary, right? Because commodities are like basic things that are used for production and food and farming and things like that, like lumber and steel and oil and wheat and stuff like that. Stuff that's like pretty important for things to keep on humming along in a society. So you definitely want to keep an eye on that, because you want to see these commodities prices roll over sooner than later. And due to the war and due to the supply chain issues, I'm not sure if they will. So point one for recessionary is that some asset prices are coming down in a good way. Other asset prices continue to rise in a very bad way. So that's something to keep an eye on. If you look at mortgage rates, just to reference, it's pretty tough to get a house right now. It's the toughest it's been to get a house from a mortgage perspective. Shouldn't say tough. It's expensive to get a house, right? It was the lowest it's ever been, basically, in 2020 with the Federal Reserve policy choices. But now it's getting way back up there, and we're actually past the pre-COVID highs from it. by a good bit. I mean, it hasn't been this hard to get a mortgage since, really about the fallout of 2008, like 2009, 2010, 2011. So worth keeping an eye on. And, maybe we'll see that roll over from an interest rate standpoint, or maybe we'll just see houses become more affordable, but the interest rates stay the same, which would be ideal. Because again, we're trying to reel in inflation. Higher interest rates is a way to do that. It makes the United States dollar more valuable as a result. Another thing that's important for recessions is unemployment. Something my macroeconomics teacher, professor, I guess I should say, taught me that's interesting about unemployment is that while layoffs increase during recessions, quits decrease significantly, which is very logical. And it actually balances things out during a recession more than you would think. And in fact, when things get really rough, people actually negotiate to work for lower wages as to not get laid off. So even though the economy might be, producing less and people are making less and the dollar is a little more scarce, it's interesting because like this idea of like just thousands of people getting put on the streets at once and them having nowhere to go or no new job to find actually hasn't really been the case in the United States in a long time. The closest we ever got to it was 2008, and we bounced back pretty quickly, right? The idea that it's just impossible to find a job is more or less, hasn't really been a thing for quite a few decades in the United States. Not saying that it can't happen. I'm just saying that's, positive. And the employment rate continues to be substantially low. And by all recession indicators, like as long as the unemployment rate's low, then we're not totally in a recession. We'll see what happens here because we might have hit a bottom with unemployment and we might start trending back upwards eventually here. So you want to keep an eye on that. So, commodities prices continuing to increase, you want to keep an eye on. Housing prices maybe rolling over, you want to keep an eye on. And unemployment rate going back up, you want to keep an eye on. But, people that were hiring like crazy not 6 months ago. So it's just crazy what 6 months can do to an economy, right? This is the Global Supply Chain Pressure Index, brought to you by the New York Fed. I wish they would integrate this index into the St. Louis Fed's database, but they haven't, so that sucks. But it's a great little index, and I've used it a lot since we have been having a lot of supply chain pressures. And we're seeing, a quick pivot up for April. And again, I think this is just being exacerbated by the war and with the cost of energy and, all the other supply chain issues we're dealing with obviously the supply chain issues we're dealing with are contributing to the supply chain pressure index. Really insightful analysis there, John. But yeah, I mean, it's interesting, right? We want to keep an eye on this. I would say if this continues to increase along with commodities prices and then unemployment rate starts going up, I would say, the argument that we're likely to be in a recession is pretty high. For how long, I'm not sure, right? And I think all of this also depends on Federal Reserve policy. If inflation rate doesn't start coming down along with all of this, we're in trouble, right? So you want to definitely be aware of what the inflation rate's doing on top of all of these other issues. But what's interesting is that the GDP-based recession indicator index, which essentially this is the percent likelihood of a recession. And now keep in mind, this is quarterly, which means we haven't calculated this most recent quarter. We won't, I believe, until June. This is only showing quarter 4 of 2021, so it's not even showing quarter 1 of 2022 yet. But we haven't increased yet. So probably I think this will get updated in June. I would like to see where this is headed, the next 2-3 months to see if the likelihood of a recession just based on a GDP, right, gross domestic product, how much stuff is getting made in an economy index, is actually contributing to the likelihood of a recession. And I can tell you from experience, like stuff isn't great right now. I know from an investment standpoint, which is really important in an economy and not stock market investment. I'm saying like small business investment, right? That's dried up a ton lately. The reason that I know that is because I'm super involved with a bunch of different startups and younger businesses. And it's like venture capitalists just aren't looking to move in this market quite as much. I'll leave it at that. And you should, if you are a founder or in a young business, you probably have felt that, right? If you're relying on investment of any form, the tone, the context is different. There's fear in the air. People are more likely to hold on to their money than they probably were even 6 months ago. So important to keep an eye on. And additionally, people just aren't making stuff as much because of these supply chain issues, and they aren't, contributing to production and contributing to economic growth as much. We had the first negative, GDP growth in a while last quarter, and we'll see if that keeps up because we don't. Let's see. Right, obviously decreased with COVID, and then look, it trended down from quarter 4 to quarter 1 of 2022. Trended down. So that's not good, right? I'm not saying it needs to skyrocket for the economy to be healthy. Actually, I think quite the opposite. I think like 1-ish% growth in our economy per year is healthy and normal, and we'd like to keep it that way. Stops things from running too hot. So there's definitely some issues. And, if you feel issues with energy costs or your cost of living or gas prices continue to skyrocket and stuff like that, like you're going to call it a recession. You're going to call it what it is, right? If it walks like a recession and talks like a recession, it's probably a recession. And if you're feeling the burn everywhere you go to spend money and everybody's holding on to their investment dollars or just their money in general, or where they're going to spend it, or where they're potentially going to invest it a little bit more, like it's those are all recessionary indicators. So you have to keep an eye on it. How long this lasts, who knows, right? I think the main thing, which I've been saying this for months now, is inflation needs to come down. It's a problem. I keep clicking on the wrong indicator. Inflation needs to come down. It's a problem. This needs to roll over and just start trending, like it kind of was in the past, like this, rather than this. So we'll keep an eye on that as well. One thing that's positive is the dollar index finally is like taking a breath, but I'm not super convinced that like the markets have bottomed by any means. I think they will bottom probably within the next like 6 months to a year, like barring like nuclear war or aliens invading or something like that. But I do not think they have bottomed. I think sentiment's really dismal. People are really scared, and there's reasons for people to be scared. And all of these indicators and indexes that suggest that things are kind of crummy have yet to roll over and suggest that things might be getting better soon. So just try to keep an eye on all of that, right? Don't ignore what the gas pump and the grocery store and the housing market's telling you. And be careful about where you're spending your money. And, maybe if you're looking to get aggressive about moving your job right now, this might not be the time. Hey, John, it's been a minute. Hope you're doing well. Alex told me you had a channel, but your name is Woods, so I don't know who this is. And I know a lot of Alexes, so you'll have to specify, but I'm going to be excited to hear whoever this is that's commenting. And I'm sorry that I don't know based off of your YouTube name. Yeah, so I just ranted for a really long time. Hopefully all of this was informative. Hopefully all of this was helpful. And hopefully you're not feeling the pain of a recession too much, to all of you who decided to tune in and watch. I'm just going to stick around for another few minutes for questions. Unfortunately, I do kind of have a harder stop at 9. I have a lot of stuff with work that I got to take care of still. And I just want to get ahead of it for my day tomorrow. But yeah, I'm going to stick around, take some questions. I see there's still a few people watching right now. Right. How do you feel about the Federal Reserve situation? How do you feel about the cryptocurrency market and Bitcoin's function as an inflation hedge? How do you feel about the fact that we could be in a recession? I'm curious about all these. Oh, what's up, dude? Are you still on the team? I hope things are going well. If you are, what did I just do to my indicators? Uh-oh. Right. Yeah. I haven't talked to Alex in a minute too. Probably more recently than you, Zach, but I digress. But I know Northwood Esports. So I went to Northwood University. I got a a major in economics with a minor in, a major in entrepreneurship with a minor in economics. You guys think my degree's fake at this point. And then I got an MBA at Northwood. Great school, phenomenal faculty. I'm so happy about the time that I spent there. I felt very prepared for the job market as a result. And also on top of it, the esports team there that I played on for just one semester. Unfortunately, I just didn't really have time for it, and I'm not that great of a gamer. I was just more so doing it for fun. But the esports team in general is amazing. They've won like several Rocket League championships, and they're very fresh. Cody, I think, is the manager over there. He rocks. So, not great about it. Can you go over your thoughts on Bitcoin real quick? I just tuned in. Also, think of any other cryptos worth the investment. I will take a quick crypto divergence here because that's kind of my specialty. So what I wanted to talk about with Bitcoin, that I will just very briefly sum this up since I already talked about it on stream, is I would suggest that Bitcoin served as an inflation hedge because Bitcoin skyrocketed before the inflation kicked in, right? People are saying it's bad as an inflation hedge because we've been in a downtrend since the inflation started around here. But they're discounting the fact that it increased 1,500% before the inflation kicked in, right? So it functioned as an inflation hedge because once the inflation kicked in, people were able to take profits and go put them into, whatever, and actually use them for, whatever purposes they need to handle the inflation situation better. So that's my very brief answer to, was Bitcoin a good inflation hedge? My thoughts on Bitcoin is we're going to remain bearish for a while. I think that this 30K level that people are hoping holds as a bottom is not going to hold. I think we're going to get a fake rally to the upside, and people are going to think that 30K was an effective support. And then I think this is going to keel over, and we are going to visit the 200-week moving average, which is currently at $22,000, right? Now, this average can increase. It will increase. But this is where I'm looking for a bottom. Why is this where I'm looking for a bottom? It's because every time Bitcoin has bottomed, it has been around the 200-week moving average for a weekly close, with wicks going as low as the 300-week moving average, which I do not have the 300-week moving average here because we visit it so briefly when we do visit it. So a weekly close as low as $22,000 with wicks below, which means you can spend a day or 2 or 3 down there at something as low as 17, 16K. So worth keeping an eye on. Also, your other question was, are there any cryptos worth investing in? I have 1 or 2 altcoins that I am fundamentally bullish on that I dollar cost average into every month regardless. But this is generally not the market to be investing in altcoins whatsoever, especially if you don't have any fundamental belief in the technology of that altcoin. And please, for the love of God, don't convince yourself that Doge has some kind of fundamental technology driving it. It does not. It's completely speculative. It's completely fun money to trade, right? And in bear markets, fun money to trade doesn't really exist because you don't have retail coming into the space and putting new money in. And the best way to illustrate this is through Bitcoin dominance, which has been increasing substantially, which means Bitcoin is beating the alt market. It is outperforming the alt market. Another way to look at this is putting, instead of the United States dollar in the denominator of your altcoin valuation, you put Bitcoin in the denominator of your altcoin valuation. What will you see? Past month, Ethereum has gone down versus Bitcoin. Polkadot has gone down versus Bitcoin. Atom has gone down versus Bitcoin. Cardano has gone down versus Bitcoin. Link has continued to go down versus Bitcoin horribly, in fact. Matic has continued to go down versus Bitcoin. Ren has continued to go down versus Bitcoin. BNT has continued to go down versus Bitcoin. Look at that setup that didn't play out, LMAO. Right. I think you get the point. Do you trade full-time as well? It depends what you mean by full-time. No, I don't make my primary income through trading, but I do trade. I keep a close eye on the markets, and I do tend to trade. I actually sold a lot out right here because I was convinced that we were going to 30K. And I re-entered some here because I'm relatively convinced that we're going to have a bounce at some point. And then when we have that bounce, I'm probably going to make some sells there. This is what I'm going to do. I'm not going to say how it's going to play out because I cannot predict the future. But I do expect a bounce so that people think this was the bottom, and then capitulation down to the 200-week moving average. That is my expectation. My expectation, right? It doesn't mean it's what's going to happen. That's just what I expect to happen. So I swing trade. I look for, more major moves in the market. I'm not day trading. I'm not in and out all the time. I just, well, if I see value, I'll take advantage of it. And if I anticipate, a downtrend, I'll try to take advantage of that the best I can. Anyway, Zach, I appreciate you tuning in. You're actually, I think, one of my first people to tune in via YouTube rather than Facebook, where most people are making comments and interacting. So I appreciate that. And I hope you've been doing well, and I hope the team's going well. Anyways, guys, with that, I think I'm going to wrap it up. Long story short, keep an eye on what the Fed's up to. Invest in assets that you think have fundamental value over long time horizons, and you'd be positioning yourself pretty well in these bearish times. And do whatever you can to hedge against, recessionary pressures of rising commodity prices, house market being an issue, inflation being an issue, supply chains being an issue. And be careful and keep an eye out for those things. If you have to blow through a lot of your savings to go on a vacation, this unfortunately might not be the year to do it, type vibe, right? You might not know what you're going to need that money for, and you don't want to be in a tough position like the Federal Reserve currently is. So I hope you guys have a good night. Stay safe out there, and hopefully I'll see you guys next week. Oh, one last thing. I'm releasing a football podcast with my buddies Mark and Zach on Friday. So if you want to see a bit of a change of pace in my commentary, not this boring data science stuff, and you just want to hear me talk about football, that might be a little bit more chill and laxed for you guys. So anyways, have a good night, everybody, and I will see you next time.